Hi again, Michael Beresford here from OpenCorp along with Matt Lewison, OpenCorp CEO. Welcome Matt, always good to see you.
It's great to be here.
Excellent. Well, look, we get asked on a daily basis at OpenCorp, where should I be investing? Where's the hot spot? Where should I be looking to get the best possible result? The short answer is that depends on everyone's individual circumstances and their investment strategy. But what I wanted to unpack with you today is how and where do investors out there go about getting the best property market insights? Because we see a lot on LinkedIn and in the market from research houses like RP Data, CoreLogic, Domain, etc. And they talk very much about what's happened in terms of economic data, but we want to be ahead of the curve. We want to be forward-looking. How do you and your team go about it at OpenCorp?
Yeah, look, it's a really interesting question because I think we all want to know what's going to happen, and nobody has a crystal ball. I think I'd love to have a future me come back one day with the investment guy to say, here's what the next 30 years looks like, but we're not going to have that. So the best we can do is to understand what's likely to happen and to use a degree of logic for that. But you need to go through a lot of information to be able to make an informed decision. When I started investing, I remember we used to have a bunch of different property magazines and we would go through them, we would read all the stories, but often we were just finding people's opinion that wasn't always based on a lot of fact. It was either bias from a local agent talking about their area, or somebody talking up renovations, or it was very specific, and I wanted to have information that would help me make an informed decision, not just rely on theirs. And I always found myself gravitating towards the tables that were at the back of these magazines that had the vacancy rate data and the rents and what had happened with the rents in the last 12 months. There's like thousands of postcodes to work through. And obviously that was very, let's call it lo-fi at the time. But these days there's really good data sources to give you information about vacancy rates. And it's always a great starting point is to understand the vacancy rate for an area, because it's a good early indicator of supply and demand. And also looking at housing supply listings, how long listings have been on the market, if it's going up on a sustained basis, whether the length of time that listings taking to sell or the number of listings in an area. It's again an indication that supply is starting to exceed demand. SQM have some great data in that regard. Now, as you said, the one downside is it's looking at the past. And it's not to say it's not important and valuable to be able to look at the past, because it does give you a good starting point to build your, your investment thesis on before you make a decision. So that's a great starting point. Now, we also have CoreLogic. It's got a huge amount of data, and in particular, they're tracking the median house price and property transactions. Again, that's telling you what has happened in the past. It actually doesn't tell you a lot about the local supply and demand. And again, that's kind of why you can't just go with one source of information. It's a really big differentiator between SQM and CoreLogic. SQM's got the great kind of suburb-specific information, and CoreLogic's got some aggregated data. So again, a really good source, but seeing that prices went up 10% last year doesn't tell me what's going to happen next year. In fact, some would say that if the price went up 10% last year or 20%, then it's probably less likely to keep going up that amount in the year ahead. I want to know which suburb or area is going to go up 10 or 20% next year, not which one went up 10% last year. So obviously we can go through that to get, and there's a bunch of different sources where we can get information on what's happened. But really, for us and our team, for us to make an informed decision and to develop our thesis on which areas are going to be the best to invest in, we have to trawl through things that are telling us where the demand will be in the future. And to get this, we need to look through federal, state, local government budgets, understanding where the infrastructure spend is, understanding where the incentives are for the workforce. Are they trying to bring in and promote, I guess, different types of trade or skilled specialists, and where are they going to be situated? And if they're going to be situated in a certain area, is there infrastructure to support that as well? And where are they likely to settle if that's where their jobs are? So we start looking through a lot of that information. Then there's also a bunch of different housing organisations like NIFIC have some great data. That's the federal government's Housing Finance and Investment Corporation. And they're looking specifically at, I guess, housing stress and homelessness is an important one. We're looking at jobs. We're looking to see where are wages going up, which suburbs have got great wages, but affordable house prices. Again, it's not telling us that sometimes that might also correlate with their prices have been going up, but often they haven't started to go up yet because that trend, initially you bring in people with better wages, it doesn't instantly push the price up, but it has a flow-on effect because those people with better wages might have moved into the area where the housing quality and the housing stock is actually not great, and they're looking to revitalise, they're renovating their houses, they're adding value to it, and that's inflating the house price in that area, which means that obviously building new in that area, you can actually catch some uplift and get other values. So we're looking for all those little kind of sources of information that's giving us a head start on where the next wave of growth, and first starting point is where's the population growth, second, where are the wages going to go up, third, which areas are going to be opened up by new investment that'll add value and improve the amenity to make them more attractive, which in turn brings people in to those areas. So
it's clearly a time-consuming process, and I guess that's why we've got a team to troll through all of those data sources. You mentioned median house prices. I just wanted to touch on those because we often talk at OpenCorp around the kind of indicators or the metrics that the market use and the media use. The three obvious ones that come to mind are, house price growth, which is they're referring to the median. Auction clearance rates is another, and the good old property clock, like where on the clock is location XYZ, as an indicator of what's going to happen. Can you give everyone the quick ABC on each of those and what they do tell us, but more so what they don't tell us and what we need to understand over and above?
Yeah, so if I start with the median house price, and look, as a very early and rough indicator, if you own property and you want to know whether your area is performing well or bad, it might be a reasonable place to at least have a glance. But what the median house price doesn't tell you is whether prices at the bottom end of the market of certain types of houses are going up and prices at a different end of the market, let's call it the premium end, might be coming down. And we've seen this over the last 12 months where the premium end of the market has underperformed. In fact, if you go from 2018 until now, the lowest 25% of house sales, the median house price has gone up by about 34%. And in that same period, the top 25% of house prices have only gone up by 11%. So we're seeing two very different trajectories for different segments of the market. And when we see the median house price for a city, for instance, coming down, what we're often seeing is that there are fewer houses at the premium end of the market being listed. It's at a time of uncertainty. If somebody's got a multi-million-dollar house, if they can afford to not sell it, they'll sit on it for a while longer. So because they don't list those houses, they don't get sold, so they don't add to the median house price composition. Whereas at the bottom end of the market, we're seeing more transactions, and this is particularly the case over the last year, the entry price has been going up pretty consistently. So while the median house price for a city is coming down, the entry price is going up because at the bottom end there's price pressure pushing up house prices. So it can be a misleading indicator. I'm not saying don't look at it, just saying don't use it as your sole source of information.
Just before you go on, so to be really clear for everyone out there that's not aware, the median is a middle value.
Middle value.
Right, so it's not an average, which is often talked about. It's the middle value in a distribution of sales. So to Matt's point, if the top end sales at the most expensive price point aren't occurring, then naturally the middle value will drop and shift towards the more affordable end, especially if that's where the majority of the activity is. So we can see a median decreasing, but the affordable end or the entry price increasing, just to clarify that dynamic for you.
Yep, absolutely. So we've got median house price. The other one that gets reported on quite a lot is the auction clearance rate. So the auction clearance rate, which pretty much tells us how many properties are trading. It's not new supply. And often it's like musical chairs. Somebody's leaving one chair to move into the next chair. So temporarily they're vacating their chair, which puts one more property on the market. somebody buys that, and the person who sold their house goes and buys another property. So they're pretty much just transacting and trading properties. So again, it's a temporary measure that focuses on perhaps very local short-term supply demand of essentially trading houses, not of adding new stock to the market. And it certainly doesn't tell you whether more people are moving into that area than there are houses getting built. And then the property clock. So the property clock, this is a tricky one because we do very strongly believe that markets go through cycles. But I think we believe that this, I guess, industry slogan of there being a property clock and where does it sit in the city sit in the property clock can again be misleading because property in different parts of a market can perform very differently. A really good case in point, you look at Melbourne and the way Melbourne has settled, and the geographic centre of Melbourne is very heavily weighted to the southeastern suburbs. So for decades, the western suburbs underperformed the eastern suburbs. They were almost in different property clocks if you were looking at it that way, because demand and supply were so different on each side of the city. And obviously that changes over time. If you look at any city around Australia, and particularly cities with rivers, you often find that just on one side of the river to the other, there is a very different housing market. And it obviously radiates out from the city as well. And the north and the south can be vastly different from each other. And just because there's an oversupply in the southern suburbs doesn't mean there's an oversupply of housing in the north. So hence the reason why following a property clock for a whole city can be a really misleading approach. And again, we're not investing for what we think is going to happen in the next 6 months. We're investing for like the long term, but we absolutely want to pick up the growth in the next 18, 36 months over the next sort of 2 years. And we want to invest where we know we're going to get the best growth in that longer period of time, or we're most likely to get that. And so that's why we're looking at those leading indicators of where is the demand and supply. Just because a market's been subdued, sorry, the last thing I was saying, the property clock, just because a market has been subdued doesn't mean that in 6 months' time it's going to turn around and be booming. So if you go back to 2014, when Perth came off a massive boom and shifted into what might be, what do they call it, the 6 o'clock on the property clock, where it's kind of a recovery phase. Well, that recovery phase lasted for 7 years before the market was primed to go again. And now it's had a really strong run that's likely to continue for a bit of time. But again, if you're just looking at this property clock and think there's a finite period of time between phase A and phase B, or boom and bust, then I think you're going to make a lot of bad decisions.
Yep. Well, Matt, as always, thanks for the insights. Amazing information there for investors on where they can get the best insights and most importantly, understand what we hear and read every day in the general media. We need to look beyond that. We need to dig deeper. We need to be, using foresight to be able to be ahead of the curve to get the best results. So, hope you enjoyed it. We'll be back next time.